But I want to bring in John Ryding, who's been patiently sitting here. He's the chief economist at RDQ Economics. And John, are you confused by what Bernanke is admitting?
No, not at all. I mean, the central bank chairman is watching inflation. Well, you would hope so. I mean, if they're supposed to watch something, they're supposed to watch inflation. And Bernanke is saying, wrongly, in my opinion, but it's been his consistent stance, that commodity prices aren't the Fed's fault, which I find a very strong and inaccurate statement.
Are not the Fed's fault.
Are not the Fed's fault. They're due to stronger growth here or other things going on there. But I think higher energy prices, higher food prices, higher commodity prices are the Fed's fault. And they won't prove as transitory. So the little nuance there is, well, if I eventually get proved wrong, then we'll take action. But here's the problem. We've got rates at zero. We've got a Fed balance sheet that's still growing. That balance sheet's approaching $3 trillion. And they're saying, well, if it turns out that inflation doesn't go away, then we'll act. But the cost of acting becomes so much greater. This is not a Fed that's willing to be preemptive on inflation. We had the same message last week from a much more dovish Fed president in Bill Dudley, who say Fed presidency, this one eats iPad 2s, according to a recent speech.
But John, what tells you, though, that the commodity price inflation is temporary, transitory?
Nothing tells me that. We have watched the consistent linkage of quantitative easing and higher commodity prices. Now, what's interesting is Bernanke wants to take credit for higher equity price and said the equity market bottomed right around when they started the first round of quantitative easing. But so did commodity prices. And the weekly correlation between commodity prices and between the equity market has been extremely high. It's been almost 0.9. So it's very hard to say we're going to take credit for this. But commodity prices are due to bad crops, economic growth elsewhere, and so on. To me, the Fed is looking at this incorrectly because they wrongly think unemployment is going to restrain the inflation story. I think we're going to have a kind of 1970s mini stagflation repeat where we have high unemployment and inflation that proves not to be transitory.
But QE2 goes away at the end of June and then Fed securities start rolling off. So you start to get a little bit of a tightening effect whether the Fed acts or not. Bernanke suggests, and Dudley too, that that's going to start to bring down some of those prices.
Well, first of all, we've got to see that they actually do permit it to roll off. Remember that Fed policy prior to engaging in the last $600 billion was to reinvest the proceeds, the pay down. Secondly, if you look at the pace of the payoffs, the pace of those payoffs compared to the rate at which the balance sheet accumulated is maybe the balance sheet will run off by $20 billion a month. Well, right now, the buying net $100 billion a month. So 1 month's purchases will take 5 months to roll off. The amount of tightening, given the size of the balance sheet, $1.75 trillion of mortgages, another $600 billion of treasuries, almost $200 billion of GSE debt will take forever to roll off. And so the question is, the Fed presidents last week signaling an active exit strategy in the second half of last year. I think Bill Dudley and Chairman Bernanke are saying, not so fast. We're going to keep this policy in place.
Do you think, though, what Mike was just saying about, what Bernanke wants, Bernanke will get? But you're getting more and more dissent within the Fed. I mean, do you think eventually he will get what he wants?
You are getting more dissent, but interestingly enough, the only active dissent in terms of a dissenting vote you've had was Kansas City President Tom Honig. Now, he is no longer a voter. What we have to see is whether the new batch of presidents, who, like Charles Plosser, gave a very structured speech called Exit, capitalized, is how he would see the Fed getting out of this, whether they can put enough pressure on the chairman. I don't think that they can until inflation has proved high enough for long enough that the Fed chairman is going to say, well, it looks like I was wrong, but you know what? They haven't yet owned up to the housing bubble, so it takes a long time for them to say that they were wrong on things.
What would you do at this point? What should they do?
Well, I don't think they should have gotten into quantitative easing, at least the second round of quantitative easing. I think they panicked at the end of last year. And so it's very interesting that a middle-of-the-road Fed president like Koch Lakota comes out with a speech last week and said, well, if core inflation's gone from 0.8 to 1.3%, maybe we should respond to that with a higher funds rate. So we're going to see the ECB probably raise rates tomorrow. That'll be the first move by a major G7 central bank. We've seen moves by Australia and India and other central banks. But that'll be the first move by a G7 bank. Well, not strictly true. We had Canada raise rates earlier. But ECB goes tomorrow. They're going to keep the support systems in place. The Fed should be moving to that kind of exit strategy, but they're not. The interesting thing, will they signal exceptionally low rates for an extended period on April 27th? My guess is they will. And why? Probably because they're looking at a soft first quarter in GDP terms.
John, we've got to leave it here, but great having you here with us and talking about this. Always provocative. John Ryding, Chief Economist and co-founder of RDQ Economics.